Buddy. Good morning, Brad. So
Good morning.
today we're gonna go a little bit deeper into just investor cash flow and the details of the requirements a little bit. Brad, I'm gonna turn it over to you.
Thank you, sir. Well, Accra has two main programs, I would say. Actually, three. We have our, bank statement loans, and then we have our DSCR, investor cash flow deals, and then fix and flip, which is like a short-term bridge. So this investor cash flow or DSCR program is one of the main branches, and there's a lot of little sub branches that branch off the program, and we've talked about that uh, throughout our throughout previous Facebook lives. So, the DSCR, it's the investor cash flow, the property's ability to cash flow as opposed to qualifying a borrower necessarily off their tax returns or, their income or their job, that type of thing. Um, so ACRA, just in general, we don't really have any maximum finance property requirements. So if you have 100 properties that are financed outside of ACRA, we'll still allow you to buy another property. Now we usually will have aggregate limits here, but once you start to get like a proven track record of you paying your payments with us, then we'll allow that cap to go higher as time goes on. So usually we'll aggregate or we'll allow a maximum of up to 5 million or $5 million worth of loans outstanding until we can see a proven track record. Um, so that's one of the things that Acra has, as opposed to maybe buying an investment property through Fannie or Freddie. Usually Fannie or Freddie, they limit it to what, 10 or 12, Jacob. Um, so we don't necessarily have like a number.
10. Yeah, yeah,
Yeah,
10.
yeah, we don't have a number. We more have like a dollar value at upfront until you start to have a proven track record. Now, there's a couple of things that you can do on the investor cash flow to help squeeze out more income on your appraisal. So it's really approaching it up front from the setting up the file and presenting the facts to the appraiser or the AMC. If you're going short term versus long term, you definitely want to try to gather as much information as possible to present to the appraiser. That way they can take that information into consideration whenever they're giving you the rental estimates or the cash flow. Because if not, they're kind of flying. I don't want to say blind, but maybe they're just not 100% sure of what cash flow you can kind of bring in certain areas or certain properties. So, as an example, if you're here in Orlando, Kissimmee, for instance, there's just a lot of short-term rentals. And even though the appraisers
Mm.
know that, hey, Kissimmee is a short-term rental just city, I mean, there's just a lot of them there, you still want to try to get an idea of what the
Yeah.
cash flow is of the property up front. So what I have, the buyer's agent do is ask for a 12-month or 24-month, if they can get it, rental ledger. If it's on Airbnb, VRBO, if it's being professionally managed by a management company, and if it's like a condotel, maybe the front desk, or maybe they have an on-site management company that's managing it, get some sort of ledger to show what this property is actually bringing in. So that's kind of one trick to squeezing out a little bit more income. Now, if you're in another area that's not necessarily known for short-term rentals, but you have little pockets. So, in certain cities, there's just short-term rental pockets. It's usually by beach towns, it's by resort areas, Vail, Colorado, Breckenridge, around Yellowstone, Joshua Tree out in California. There's just a lot of like little pockets, maybe South Padre Island around where you're at, Jacob. that maybe the whole
Mm,
city
yeah.
isn't necessarily geared toward that, but little pockets are. So there's
Right.
actually a little snip of the USPAP guidelines that I send out to broker partners and say, hey, send this to the appraiser and make sure that they take into consideration the highest and best use of this property. So those are a couple little
Mm,
tips and tricks to where you can, hopefully squeeze out a little bit more income on short-term rentals. On long-term rentals, you could kind of approach it the same way too. Try to get lease agreements. Try to show what the property is actually bringing in, not what they think it's bringing in. Because a lot of times the comps, they're close, but they're not necessarily accurate. Um, so the appraiser's only
yeah.
going off of their database that they're pulling up online, and who knows how accurate that database is. So try to help out your appraiser
Right.
by getting some sort of rental ledger or lease agreement up front. Send that to them and have them review that before they take into consideration what the rental estimate might be. So those are a couple little
Mm,
tips and tricks on
okay.
trying to squeeze out a little bit more income. Now, the flyer that you see that Jacob has pulled up, it does need to be updated. So there's a couple little things on here that I just want to kind of hit on, and we've kind of hit on some of this stuff in the past, but just as a refresher, um, we do allow the DSCR program on not necessarily just 1 to 4 units, but up to 5 to 29 units without exceptions here. You can actually go far beyond that. The DSCR, or the investor cash flow, it's calculated a little bit differently whenever you start talking about multifamily. It's more based off like the net operating income minus all the liabilities and taxes and insurance, um, as opposed to just what the rental estimate says minus the PITIA. The 5 to 29 units, we
Mm,
also calculate the DSCR just off the PNI, not the full PITIA, because actually in the numerator of the
yeah.
equation, the PNI is already baked into there, so you don't have to put it in there twice.
Quick question.
Um,
So, but the taxes and insurance
uh-huh.
have to be a part of the mortgage payment?
So not necessarily.
Mm,
We don't necessarily have to have escrows impounded. They are as a default here, but if you want those
okay.
removed, usually you add a quarter onto the rate.
Oh, okay.
And then you have
Okay.
to have it, it can't be over 80 LTV. And I think
Yeah.
the FICO has to be above a 625, I think. It's kind of a weird number,
Okay.
so I always get that a little bit confused because we have a couple of different
Yeah.
tiers for various different things. So I think it's 625, but it's
Okay.
it's defaulted in to where we will impound for escrows. If you want us to have those removed, we do add a quarter typically because we want to make
Okay.
sure that all those things are paid and you're not delinquent, especially under taxes. So we don't want to run into any tax
Yeah.
issues. So that's why we
Yeah.
always, impound for escrows, and that's mainly true for most lenders anyway. So it's
Yeah.
not
Yeah.
anything that's
Okay.
specific to Acra. Um, so yeah, we allow this program on 1 to 29 units. Again, like I've said before in the past, you can be an I-10 borrower or a foreign national. It doesn't necessarily have to be a U.S. citizen that can qualify for this type of program.
Mm,
No reserves required at all. Before
that's
a
good.
couple of weeks ago, we were requiring reserves at 80 LTV. And also, if the property was negative cash flow, we would also require the negative cash flow to be um, we needed the negative cash flow for reserves too. So if your
Okay.
property was like negative $100 a month cash flow, maybe the PITIA was 1,900, but your actual rent rolls were 1,800. Then there's a negative $100 there, and we would make you
Yeah.
have that for 12 months. So we don't
Okay.
require that anymore. so no
Yeah.
reserves at all. But if it's
Mm,
negative cash flow, we do start to reduce the LTV down and then also bump the rate up. So you want to be very mindful of what the cash flow ability is. And that's just
yeah.
smart for any investor. Like, why would you buy a rental property whenever you're not making the mortgage? It's just not smart.
Right.
So,
Yeah. Yeah.
um,
Yeah. Yeah. You're
now,
paying out of pocket.
if you're in a position where, maybe the house is in a little bit of disrepair. You're trying to fix it up a little bit, and then in maybe 6 months or a year, that you can get 2,500 as opposed to 1,800. Then that might be a good reason to buy that investment property. Just based off of projected rental estimates.
Mm,
The other thing, maybe you're buying a property that's mid lease. I actually had in North Florida, up there by the Panhandle, I had a borrower that literally had a negative 50% or a point 0.5 on the DSCR ratio. So the PITIA was like 4,000, but his rental lease agreement was 2,000, but it was only for the next
yeah.
6 months. So unfortunately, we had to go off that $2,000 for because that was what the current lease was for. But he ended up still buying it because he knew
Oh,
that
okay. I see.
once the
Yeah.
lease was up, he was going to raise
Yeah.
the rent, to 5 grand, I
Yeah.
think it was.
Right.
So,
Got it.
there's certain scenarios where it makes
And
sense.
the comps showed that he could get 5 grand.
Yeah,
The
he was an
appraiser had to
experienced.
show that there was comps.
Yeah, he was an
Mhm.
experienced investor. He found a property that I think somebody died who was the current owner, and
Yeah.
it was owned jointly, and the wife or
Yeah.
the husband or something, they just didn't want to deal with it anymore, so they ended up selling it.
Yeah.
So there's always those types of scenarios that you come
Okay.
across. But now it also says
Right.
loan amounts up to 2 million. That's not necessarily the case. On an exception basis, we can go a lot higher than that. Also, on 5 to
Mm,
29 units, we actually allow a maximum loan amount of up to 7.5 million, and that still
okay.
falls under this investor cash flow program.
Yeah.
So,
All right.
and we do have a 5 year 7-1 arm that you can go interest only off of for 5 years. Our normal term is 30-year fixed, and then also we actually now have a 40-year uh, mortgage, which is the first 10 years it's
Mm,
interest only. So
wow.
that you add a little bit to the
Wow.
rate.
40
It's
years.
Yeah, there's a little bit of
Yeah.
a rate bump there, but that might also help you with the DSCR ratio to qualify. That way you don't have to take that higher rate bump and bring more to the
Yeah.
table. So
What kind of difference would you see if you were to go from like 30-year fixed to like a 7-year or 5-year arm? Like half a point or quarter of a point in rate or
well, it's a quarter if you go 5 year interest only. It's 3/8 if you do the 10-year, 40-year option.
so like a
Is the
quarter
rate
in the
bump?
difference though. Quarter in
Yeah,
the
it's a
difference.
rate
Yeah.
increase. Yeah, but
Yeah.
but that
Yeah.
but that'll help you with number one. It'll help you with a little bit of a lower payment,
Yeah.
and then also it helps you with the DSCR ratio because if you're negative on the cash flow, or if you're negative on the DSCR, or I should say sub one on the DSCR, then you're going to
Yeah.
have to bring a little bit more to the table typically, and also the
Yeah.
rate's going to be higher anyway. So it
Okay.
makes sense in most cases to try to go interest only. That way you don't have to worry about LTV and rate fluctuations if negative on the cash flow. So,
Yeah.
but that's kind of my job is to
Okay.
help figure that part out. Hey, if we're negative on the cash flow, here's another option that we could go, and they can always refi out of it later if they want to. But
Nice.
now,
Cool.
speaking about refining, if this is a purchase that we're looking at, then there is a 5. Currently, there's a 5 year prepay. And that's true for most of the lenders out there. There's some lenders that have like a 3 or 4 year, but the rate might be higher, or maybe their LTVs might be a little bit lower, that type of thing. So you
For
always have to
investment
watch it.
purposes.
Yeah, yeah. So you always have to watch out for you know prepays and the rate and the terms. Essentially, it's not just based off of you never want to be focused necessarily off the rate on these investor deals. You always want to be focused on the rate, the
Cash flow.
terms, the cash flow, the
Yeah.
prepay. If you plan on refining out of it for maybe you're going to buy another investment property down the road, and you want to do a cash out refi of your current investment property to finance the new one. You always want to
Mm,
take a couple of those types of things into consideration. So,
okay. Nice. Cool.
um,
All right. Well, I think
so
that we did a good overview here, Brad. I appreciate it. So, yeah, this is
well,
good stuff. And I mean,
I appreciate it. And if anybody has any of these types of weird scenarios or just any investor deals, definitely go to Jacob. He's very knowledgeable on a lot of this stuff, and he has some pretty good programs to back it up. So hopefully, we can see some activity and we'll close your deals.
yeah. Yeah, I was just listening to some news yesterday that the inventory is starting to go up.
Yeah,
Housing
yeah,
inventory is starting to go up. So rates are
I have
higher,
seen
but
that.
yeah, yeah. Okay, good
So,
stuff.
all right, buddy.
I don't think we have any. Oh, I-10. I think I haven't put it on the schedule, but we can look at we can do I-10. We haven't done I-10,
Okay,
so yeah, yeah. I'll put that on
we
the schedule.
we can win with I-10.
Yeah,
That's
yeah,
that was
yeah.
corny
There's
right there.
no, there's a lot of
There's a
I-10
lot. There's a
loans
lot of
out there.
Yep. There's a lot of
Yeah,
I-10 borrowers in
a lot.
Texas in general.
Yeah, yeah,
Here in Florida, we see a lot.
yeah,
Georgia.
yeah,
I'm sure there's a lot in Oklahoma. So, if you have any of those deals, realtor partners, send them to Jacob.
for sure, for sure. All right, thank you, Brad, and
All right.
we'll talk again tomorrow. Appreciate it.
Awesome. See ya.
All right.